Let's look at a few examples of loss and perhaps gain contingencies. Example 3, on November 24th, 2025, passengers of What's Up Airlines, flight number 1054, were injured upon landing when the plane skidded off the runway. Personal injury suits for damages totaled $5 million and were filed on January 11th, 2026 against the airline by the injured passengers. The airline's counsel believes it's probable that the company will pay 70% of the damages claimed. The financial statements were for the year end, this should say 2025, were issued on February 2nd, 2026. Determine whether loss contingency should be recorded. All right, so what do we know? We know that it needs to be probable, has to reach that threshold of likelihood. Okay, so it meets that first criteria by GAAP. The company will have to pay out, can we estimate it? We can estimate it as 70% of the total amount, $5 million. So we can estimate it. It happened during 2025, and that's the period our financial statements are for. We know about the lawsuits by January 11th before the financial statements were issued on February 2nd. So yes, we do need a journal entry. We're going to debit an account such as, let's use the account title our textbook uses, loss litigation, lawsuit. The amount would be, what do we expect to have to pay out? 70% of 5 million, so 3.5 million. This would affect the income statement. We would show loss just like an expense on the income statement. And then our credit would be to some liability account. My book uses liability-litigation. And this, of course, would cause the liabilities on the balance sheet to increase. The next 3 examples are based on Hanover Industries, a manufacturer of food products and food processing machinery. Fiscal year ends December 31st, 2025. Financial statements issued February 20th, 26. Example 4, on November 12th, a former employee filed a lawsuit alleging age discrimination and asking for damages of $750,000. At year ends, the attorney indicates the likelihood was possible but not probable. On February 5th, 2026, Hanover agreed to pay the former employee $125,000 in return for withdrawing the lawsuit. So what do? We see that at year end, it's possible. So what would happen is when the company's preparing the financial statements at year ends, they would not record any journal entry. But before those financial statements are issued on February 5th, the company agrees. So it's certain. The likelihood is certain, and that it relates to something from 2025. So what would happen on February 5th? A journal entry would be recorded affecting the 2025 financial statements. So we would need to, in Part A, record this journal entry for the amount. We would say debit the account loss-litigation. Even though we didn't know as of December 31st, we knew before the financial statements were issued that we're going to pay out $125,000. Now, even though we know on February 5th, we're going to pay out cash, as of December 31st, we have a liability. And then B, determine whether the company should provide any footnote disclosure. Absolutely, we know that we're going to have to pay out. So we would want to disclose just information related to this lawsuit and what the information that we do know. Example 5, Hanover believes there's a possibility that a service provider may claim that it has been undercharged for a processing service. Okay, so this is someone that is doing business with us that we are not allowing them to make as much as they should make. They have not made a claim for additional fees as of March 26th, but the company thinks that it will. The company's accountants and legal counsel believe the charges were appropriate, but if an assessment is made, there's a reasonable possibility that our company would have to owe more taxes. So reasonably possible that we, Hanover, are going to have to pay out $55,000. Record the journal entry if needed. no entry because the likelihood doesn't reach that probable threshold. Should the company provide any footnote disclosures? Yes, we saw earlier that if it reaches that reasonably possible threshold, we should tell investors what we know a little bit about the nature of this potential payout. We may have to pay out taxes of $55,000 in the future based on something that happened during this fiscal year. Example 6. Hanover is the plaintiff in a $600,000 lawsuit filed in 2023 against Ansdale Farms for failing to deliver on contracts for produce. The suit is in final appeal. Legal counsel advises that it is probable that Hanover will prevail, and Hanover will be awarded or receive $300,000 in the future. So this is a gain contingency. We are suing someone else. We think it's likely that we're going to win. No journal entry for a gain contingency. Should the company provide footnote disclosure? Well, it's not a should it, it's does it want to. Hanover may choose. But again, the company should be very cautious in what it discloses. We never want to tell investors that, yes, we're going to get $300,000, because if something goes wrong and we don't get that amount, investors can sue us for making our financial statements look better than they really were.